All right, everyone. Well, welcome in. Mid-year, we're thinking about financial planning, which is pretty much what we do every single day. So, welcome into another episode of the Planning Desk. Adam and I are really excited to bring you inside the retirement income puzzle today, which is really our time-tested process for how we map out needs, taxes, cash flow, and investments and really turn from that career of generating income, creating wealth, to now actually drawing on that wealth to be able to fund your lifestyle and be able to live the life that you want. So we're going to walk you through in detail how we actually put all the pieces together, what the sequencing is, how we actually construct a portfolio, and then how we overcome some of those risk factors that typically show up when people start on the retirement journey. So with that being said, we do want to introduce ourselves if this is your first time hopping into the planning desk. I'm Jarrod Musick. I'm the CEO here at Destiny Capital, and I work closely with Adam and the rest of our advisory team on all of the financial planning that we do. I also sit on our investment committee with our Chief Investment Officer, Tim Doyle, who actually executes a lot of the portfolio design and implementation that we're going to talk about today. Adam?
Yep. Hi, everybody. I'm Adam Burch. I'm a senior client wealth strategist here at Destiny Capital. I lead our client service team, and I'm part of my role is translating our financial planning approach, including a lot of the ideas that we'll be talking about today, into really clear, practical steps that our clients can take to create confidence around their finances.
Awesome. Well, the big question that we get as we dive in is what does this shift actually look like, right? The first time we talk with somebody and they might be in their, 50s, early 60s, maybe late 60s if they've had a longer career and they're just now looking at retirement. And the question before retirement is all about accumulation, right? Am I putting enough in my 401k? Am I taking advantage of my RSUs or my stock grants? Am I doing a good job with saving and investing? And then we get to this transition in retirement. And Adam, do you want to kind of talk to us about how that mindset shifts?
Yeah, so I think before retirement, like you said, Jared, the conversation's really on saving, investing, building towards some targets. But then once a client retires, it really becomes more of an income question, and clients are always asking us, "Did I save enough? And how do I get my money when I start? How do I go from a paycheck to what are we supposed to do?" I mean, clients really don't know, and I think we have to acknowledge that that can be a challenging mental shift for a lot of people. I mean, when you've spent decades viewing your portfolio as a savings vehicle, and then you have to go, you have to make this shift where you're now seeing it as a source of income. That can be tough. And so I think we want to make sure that we're walking with clients through that transition, being really intentional, being really clear on how we're going to help them, start receiving that income.
Yeah. And so I think as we look at this, we really map this out into four different stages in terms of translating. I have this pile of wealth. I have these goals and ambitions for myself, for my significant other, for my kids, my grandkids, all of these different things that I want to do, and how we actually create a roadmap for all of that. So, Adam, do you want to go through the four stages that we have outlined here? And really how we use those to build out that retirement income strategy.
Yeah, sure. So there are really four big steps that we take to help clients get to the point where we're looking at a really structured retirement income plan. And of course, the first step is helping clients map out their spending. So we want to make sure that we understand what are the more essential or more fixed ongoing expenses that have to be funded every single month or every single year. And then what are those lifestyle or discretionary expenses that can vary over time? And that might include things like travel, entertainment, hobbies, major projects that you have planned, things like that. And I want to say that we don't nitpick client spending in any way. We don't try to pinpoint things that they need to cut out of their budget, or we don't tell clients they need to spend less money on vacations or they need to spend less eating out at restaurants or whatever it is. The purpose of that exercise is for us to get a really good baseline for what cash needs are so that we can plan around that.
Hmm.
Yeah. So the next step is helping distinguish between risk tolerance and risk capacity. And so the difference there is it's really about how do you feel about risk versus how much risk you can actually handle based on your financial situation. So we just want to walk through that exercise with clients, make sure that we're really clear on what those two things mean and where they might be either in alignment or a little bit off. The next step is making sure that we build, based on your cash needs, we build a reserve of liquid assets to help manage sequence risk, which we'll talk about here in a little bit, but just making sure that you've got enough short-term liquidity to handle those cash needs that are sort of right around the corner. And then finally, helping establish some spending guardrails and then regular reviewing the plan, the overall plan, the portfolio to make sure, there aren't any surprises. We're not being reactive. It just helps keep everything in a more proactive, tailored investment approach that helps clients be successful over the long term.
Yeah. And I think my key takeaway as we look at all of this is really this is a very human centric, this is a very individualized process. We're looking at your life and your family and your dreams and aspirations and your needs and your resources, right? And we're mapping all of those together to build a strategy that works. So we have, building blocks that we use, we have processes that we go through, but each one of these is created individually and managed individually. And that's why, we have in that little quote block down there, risk management is as much about behavior and process as it is about specific investments because it's the process that works for you and your family. So I think as we
Right.
look at the first one here, where we're creating this map on expenses, can you just give us a little bit of an overview on, kind of how we bucket the essential and lifestyle and how we really create a roadmap out over a few years for those?
Yeah, so we start with spending again because we want to make sure the portfolio's purpose is really clear and that it's not usually just one strategy. It's a combination of a few strategies. So yeah, when we're in our planning, we usually pull out things that are more discretionary or variable. Like I said, travel, charitable giving, gifting to family, hobbies, things like that. We pull those out separately because those are the things that tend to change year to year, or maybe they're a one-time thing that's planned and they won't ever happen again. So, um, and then like you said on that last slide there, it's really about behavior. And we know that spending, through all of the planning that we've done over the years, we know that spending is one of the most powerful drivers of long-term financial plan success. Yes, investment returns are important. All the other are important. But spending can make or break a plan, and especially if we're not in alignment on what we're trying to do on the portfolio side as well. So we just want to make sure, again, we're not nitpicking spending, but we want to be really clear with clients on what different levels of spending, how they impact the plan over the long term. So we already
Yeah.
sort of talked about what essential and lifestyle expenses are, but really separating those two just helps us determine again, how much of the plan needs, predictable income, and then how much of it, how much of it can we be more strategic about?
Yeah. And that's a great overview, Adam. And I think one of the key takeaways that I have having done this for, 15 years now is this is almost a giving yourself permission exercise, right? So we get the question quite often, how much can I actually spend? And so creating this map and being able to say, well, this is what goes to cover housing and medical and philanthropic and travel and all of these different things if you've been a person in a family that's done a great job saving and investing and building over time, it can be harder to actually turn on the spending muscle and say, no, we really can book, we want to stay abroad in Spain for a month next summer. Boy, that's going to be expensive. Well, if you have this roadmap that says, yep, we already plugged it in, we forecasted it out, and the numbers look great, you're giving yourself permission to do the things that are important and that you want to do. If we don't do this exercise, it still feels a little bit imaginary, like, oh, I don't know, should I be spending that money?
Yeah, yeah,
And we're able to clarify that.
yeah. That's a good point. This is one of the things we don't. A lot of people look at budgeting or when they really start to define their expenses, that can be sort of and there can be a lot of anxiety around that. We don't want it to be a miserable experience. It's really fun for us when we get to help clients give themselves permission to go spend the money on the trip or to go give money to their kids for a down payment on a home or buy that new car, whatever they need to do. That feels really good, and clients I think really appreciate that. So
Yeah. So now, as we kind of shift into, we have this map on spending. Now we start to think about investment portfolio design. And this is a really interesting element of portfolio design that most people don't think of. And it's the distinction between risk tolerance and risk capacity, which are both important considerations, but they function a little bit differently. Adam, how do we think about those two elements? And then how do we walk clients through how to think about investment risk?
yeah. So when we're talking about risk, what we really are usually talking about is the potential for volatility over time. Just so we're clear on that. So and what we often say is risk tolerance is emotional, and that's, how do you feel when markets decline significantly, for example? How does that feel to you? Versus risk capacity is more financial. It's more it's more mathematical. It's really more sort of formula based, if you will. So how much volatility can your financial plan actually handle while still supporting the lifestyle you want? That's the question we answer there. And again, we do tell clients you're entitled to feel however you want to feel. We're not going to tell you how you should feel, but we do want to make sure we answer the capacity question so that maybe you can handle more risk and you don't have to worry about a drop in the market or sometimes it's the other way around. But someone might get really nervous when markets decline, but they've got plenty of capacity to handle that because they have a really healthy portfolio. They don't spend a lot in comparison. On the other hand, we do sometimes see clients that they might feel more comfortable with risk, but their portfolio can't handle a huge amount of risk, either because of the stage of life they're in or their cash needs are higher. They need to withdraw more from the portfolio. So our job there, again, isn't to tell clients how to feel. It's really to just help them understand what different levels of market movement could actually mean for their life.
Mhm. Yeah, this is always an interesting conversation because how we feel about something may not always match the math. And I think about 80% of the time we tend to see clients feel like they need to take a lower risk profile than what their capacity looks like. So they feel a little more risk averse, right? Than they actually should be able to allocate a little bit differently to get higher longer term investment returns because they have the capacity with things like maybe they have Social Security income, pension income. Maybe they just don't spend a lot of money relative to the total amount of investments that they have. Maybe there are these other factors at play there that really influence risk capacity. And then there's about 20% of the time where maybe we don't need to go 100% equities on everything here.
Yeah,
And the
right.
client feels like, no, that's going to be great. So it's always a conversation, I think, is where I'm getting at that walking through how you feel and what the math says, there's always a right answer that's usually a melding of those two.
Yeah, and it's great when you can give clients some clarity around it, and you can see them feel better about that, where they stand.
Yep. Awesome. Well, now, so we've mapped out cash flows. We know what that looks like. We've looked at tolerance versus capacity. Now we're going to actually get into the meat of construction of an investment portfolio. And I think most of us think about an investment portfolio as which assets do I own? Which vehicles am I going to choose? Am I picking mutual funds, ETFs, individual stocks? Am I going to do venture capital? Am I going to do private equity? And the way that we really think about this is mapping out the investments to the time in which those dollars are going to be needed. So, when do you actually need every dollar inside your investment portfolio? And you don't need it all available tomorrow. And you also don't need it to all be locked up for 10 years from now. So, how do we think about this bucketing strategy to better match time need versus asset allocation, Adam?
Yeah. So the great thing about this is that we can be really intentional, and then we're not just painting the whole portfolio with one sort of broad brush, but we're thinking about it in time weighted pieces. So the short term bucket is really for near term spending goals, which would include things like cash and more stable investments or some shorter term fixed income investments. or it just might mean a more conservative allocation overall for that piece. So maybe someone is saving for a down payment on a new home, or they're going to need to buy a new car in the next couple of years, or like a lot of clients, they are retired and they're distributing from the portfolio every single month. So we know we need to have a cash buffer there to fund those monthly withdrawals, and we don't want to have to be selling every single month securities, depending on what the market's doing. So the midterm bucket is really more of an intermediate bridge with a mix of balanced or moderate growth investments, and that could include funds that are intended for college planning. Maybe you've got younger kids, but they'll be going to college in the next decade or so, and you just want to be really intentional about that. And then, of course, the longer term bucket is focused more on long term growth. So the plan has the potential to either keep pace or beat inflation through retirement, help you reach that retirement savings target, or achieve specific legacy goals you have, and really that bucket of money there is one that can afford to handle a little bit more volatility, a little bit more risk in most cases. So when we think about it that way, we feel like we get better results from the portfolio. We're being more proactive. We're being more intentional. We're not just reacting to clients saying they need money and then having to sell when the market's down, or just treating the portfolio as just one big bucket.
hmm Yeah, and I always think about tax management being a big component here. So, particularly in, taxable accounts. So if you have a regular brokerage account, something that isn't sitting inside a pre-tax IRA or a Roth IRA, and there are still tax considerations with those accounts that happen more on the distribution side, but particularly for taxable accounts. So this would be places where your, savings in excess of your 401k have gone. This could be where proceeds from equity-based compensation, like restricted stock units or ESOPs, have gone, or sales of other assets that you've done previously. Maybe you had a rental that you've since liquidated and rolled those in. That's the type of account that we're thinking of here,
Right.
where tax management really comes into play. So the last thing we want to do is either A, have to sell when markets are down. So if equity markets are off significantly, the last thing you want to do is sell equities, especially if you may need them 10 plus years down the road. So
Right.
we'd like to have things that are more stable that we can sell to be able to fund near-term needs. But also we're looking at capital gain management. So for a lot of our clients, we're trying to anticipate what do capital gains look like this year and in the next few years? How can we spread those out so that they're in potentially the 0 or 15% federal capital gain bracket? And are we running tax projections throughout the year where we can kind of forecast total income, total taxable income, and investments, especially going into retirement, have a large impact on your taxable outcome. So that's
Yep.
another element that we don't have listed here is the tax effect of doing all this, but it's great to look in that short-term account from a human level and go, okay, I've got 2 years of all of my spending planned out that's sitting there in premium money market and maybe some shorter term fixed income and cash. That feels really good. I don't have to care as much watching the headlines that, hey, the S&P 500's down 10% in the past month. That should happen just about every year that we have a sell-off of 10 to 15% in the equities market. You care a lot less if you know that it doesn't impact the money that's going into your checking account anytime soon.
That's right.
So now the fourth element, and this is really, again, the very human, iterative, relationship-driven element where we talk about guardrails and we conduct reviews to make sure that all that planning that we did as we set all this up is still operative. Maybe you thought your kiddo was going to go to, the state university, and spoiler alert, they now want to go to Duke, right? Okay, we may need to think about cash flow a little bit differently. We can reset those spending guardrails. We can reset what we have allocated in different places. So, do you want to kind of talk us through this cadence that we have, Adam, and how we think about resetting guardrails and updates?
Yep. Yeah, of course. So, like all areas of financial planning, the portfolio is not a something we can just set and forget. It needs regular review, regular adjustment. I mean, this is why when we're planning for an annual review meeting with a client, we're asking for updated account balances. We're asking for, updated income sources, any other major changes in a client's life. So, and one thing we want to try to do is help set up spending guardrails. So, which really just means defining a range for how much you can safely withdraw from the portfolio over time. And we know that markets, cash needs, and life circumstances certainly change. So it's something we want to make sure that we are reviewing on a regular basis with clients, and then helping make adjustments as needed, just so that we're all clear on expectations. We're clear on what works and what may not work under different scenarios. And so I think that's why we want to just help outline what that spending guardrail range looks like. The next piece of this is systematic portfolio rebalancing. So we just want to make sure that we're keeping it does a couple things when we rebalance. So we're keeping, for one, the portfolio aligned with the target risk level that we agreed upon with clients. So if we say, hey, we want to have a balanced allocation in this account, that we're staying within that target allocation. The other thing it does, though, is it helps replenish that short-term cash or liquid bucket over time, so that it's funding your cash needs. And then that third piece, which that's a big piece, the tax, like you talked about just a minute ago, the tax planning piece is huge. So it's really a part of really everything that we do. So we want to be really thoughtful from a tax perspective when as we help manage lifetime taxes for clients. So we want to do that through really smart portfolio withdrawals, determining what we sell and how we fund cash needs over different periods of time. And that's not market timing. We want to be really thoughtful and proactive about it, not reactive. So it's
Mhm.
really just coordinating, where are we going to help fund your cash needs from, and how are we going to do that with, really thoughtful tax management.
Yeah. And I always like to point out, everybody thinks of we have the tax code as if it's this monolithic thing and it's all unified. And we actually have like 9 different taxes that we all
Yeah.
are subject to. There's sales and use tax, there's transfer tax, there's property tax, there's payroll tax, there's capital gains tax, there's ordinary income tax, and on and on and on. So as we think about tax aware withdrawals, we're anticipating things like what's the effect on your marginal income tax rate. We're also looking at which capital gains bracket are you in. If you live in a state that assigns different tax rates for different types of income, that can be a consideration. One that I think slips through the mental cracks for a lot of people until we talk about it is your Medicare premiums once you get to
Mm-hmm.
65, which is called your IRMA threshold. And there are how many IRMA brackets, Adam?
Uh, Five. Yeah, I
I was
believe
going to
they're.
say five, so I'm glad
Yeah,
we're
I
on the
believe
same
they're. I
page.
believe there are five, and those are not gradual like our marginal tax rates. Those are cliffs. So if your income's $1 over that threshold, you pay the higher Medicare premium. So yeah, that's something we want to be really thoughtful about, and we really want to make sure we walk through that with clients.
Yeah, and that tends to be one of the most frustrating taxes that come up for people because you kind of don't see it coming and it hits you 2 years into the future because they're always looking back at what
Yep.
was your gross income 2 years previously, and that will impact what your Medicare premiums are for that coming year. So there's a
Right.
lot of different tax aware pieces that we do throughout the retirement income planning process. And that's definitely part of this ongoing review to make sure that we're always adjusting and doing the best we can based on whatever your situation and the tax code look like when those things come up.
Yep.
Now we had 2 other risks, or not risks, concerns that people typically have when they're looking at retirement for the first time. And we just wanted to address them individually, not necessarily as just part of that process. So, sequence of return risk. If you're this deep into this episode, you probably care about retirement income planning. This is probably something that you've thought about, which is oh no, what if I retire at the worst possible time? And markets are really bad right after I decide to stop working. That we hear it's one of the reasons that people may delay a retirement, or just say, I'm going to keep working half time for a few more years just in case. So, how do we think about sequence of return risk, Adam?
Yeah. I mean, this is a real risk, so it's something that we do need to pay attention to. But really, as it says here, sequence of return risk is the risk of starting portfolio withdrawals during a market downturn. And so The primary risk, at the beginning of your retirement isn't necessarily just one bad year, one bad investment year. It's really a poor sequence of returns early in retirement while those withdrawals are beginning, which again makes that whole bucket strategy really important that we talked about. Trying to make sure that we're preparing for that, we're being proactive. So we want to avoid the situation where markets are down, you still need to maintain the same income, and then we have to sell more shares of securities at lower values. So that's really what this risk is all about. So um, in retirement, the order of returns matters just as much as the average return. So you can see that in that little chart there. That's basically what that shows. And so we just want to make sure that we're managing this very deliberately and we're helping you prepare as those cash needs are approaching.
Yep. And I think one call out when we do our retirement projection models, we're using something typically called a Monte Carlo analysis, which is not about gambling, even though it's about Monte Carlo. But it's about how many randomized trials do you run looking at things like sequence of return. And so whenever
Yeah.
we do that, there's kind of three numbers. There's the average path number we want to see in, the average return, what happens. But we also want to look at what happens in the top quartile, the top 20% of market returns, and what happens in the bottom 20%. So we are stress testing as we do some of those projections to look at, hey, even in this really bad scenario, do we have a problem with you living the lifestyle that you want to live, doing the things that you want to do? So the bucket strategy helps for sure. And also doing proper projections and modeling is a key here as well.
Yeah.
The second one is, just thinking about what happens if markets fall, what happens during a drop. I think we've addressed this pretty well, but this is also one of the top concerns that we hear. So, if markets fall, what do we typically do, Adam, if we've done all this work and designed things properly?
Right. Like we talked about, we can tap into money market funds or shorter term, less volatile funds, and that's how we would fund those, those cash needs. So and that gives the longer term assets time to recover. I mean, that's
Yep.
basically the gist of this.
Yeah, and the biggest job that we ask of our clients is we need information and we need, collaborative time with you. So that's part of asking for these review meetings is to make sure, hey, have we accurately forecasted what you're going to need or have things shifted? Because we want to pre-build those reserves so that we're never in a situation where markets are in a volatile period and we're drawing on those assets in a way that we didn't expect. Okay, I'm just going to touch briefly as we wrap up here. We have our personal wealth operating system. It's our trademark process for how we do all of this financial planning and investment management, tax planning, estate planning, integration, all of those things that we do. This is really how we bring everything together. So, building a structure, coordinating the picture, reviewing it, and making sure that we're tax aware. That's all part of the personal wealth operating system. And that's really an internal system for those of us at Destiny Capital, how we look at the work that we do. We have tons of other content about that. So head over to destinycapital.com if you want to learn more about the PWS. So if we do all of this work that we've talked about, creating a retirement income plan, the result that we're expecting to get out of this and how you should feel is that there's a structure that's in place. It's visual. You understand what's going on. You're a part of the process. This is not something that, the CFP goes into the magic black box and comes out with your portfolio and everything's fine. You should really understand the why behind everything. It should be simple. We really try and explain everything in plain English. We really try to not use jargon. I said IRMA threshold, and I'm like, oh, I should have clarified what that means. And I realized I don't actually know because it's IRMAA, income something
Related monthly
Medicare.
adjustment amount. Yeah.
Yeah, see, Adam knows, right? But that's that's why we shouldn't use those types of, jargon because we want everything to be simple and we want to be strategic. So we want to be proactive with everybody. We want to be ahead of taxes, ahead of income needs, ahead of cash, all of those different pieces. So as we think about what comes next, what we would want our viewers to take away from this, Adam, if you could sum up in 60 seconds, what do we
Yep.
want people to take away from this?
Yeah, so I think the biggest thing is make sure you understand your spending. I mean, just we all owe it to ourselves to understand where our money's going every month. So make sure you understand your actual spending. Understand not just how you feel about risk, but how much you can actually handle. And that takes some work. I mean, that takes a lot of times working with someone like us. So that's a big piece of what we help clients do.
Mhm.
Um, and then, as you understand your spending needs, think about creating those buckets so that you don't have to run into any surprises. You don't have to put yourself in a worse position by selling securities at the wrong time. And then making sure you understand what your spending can look like over the long term to make sure that you stay successful and you reach the goals you want to reach, whether that's retirement or, you've got big travel goals or you've got other family goals. So it's just really making sure you have a lot of clarity around your spending, your risk, and your investments and how those things work together.
Yeah, absolutely. Well, as we wrap up, if this is something that you have questions on, you need help with, you just want a second pair of eyes on something that you've put together yourself, head over to destinycapital.com. You can book a 20-minute call. Typically, Adam or I are the ones who actually take that call. So we're always happy to dive deep and look at what your specific retirement income looks like. I'm going to leave the disclosure page up here. We are a regulated industry, so please, please, please do not make any irreversible decisions based on what we just talked about. Talk to your tax, legal, investment, whoever team to help you make good decisions. We really, really appreciate your time today, and thank you very much for taking some of this, and hopefully it gives you some good look fors. And we will be back again here in another couple of weeks with another planning desk episode on a really interesting topic.
Yeah. Thanks for watching.